All right, let's talk about a word you hear absolutely everywhere. On the news, in company reports, maybe even floating around your own office. Revenue. It sounds so simple, right? But what does that number really mean? Well, we're going to dig in. Okay, so let's start with a classic puzzle, one that trips up even people who follow the markets all the time. A company puts out a press release, record-breaking revenue, best quarter ever. And then you look at the stock market, and their share price is tanking. How on earth is that possible? It feels totally backward. But the answer tells you everything you need to know about what revenue is, and, more importantly, what it isn't.
To figure out that puzzle, we've got to tackle the single biggest misconception in all of business. Honestly, it's a super common mix-up, but once you get this one idea, you pretty much unlock the secret to understanding how healthy any company truly is.
Okay, let's just get a really clear definition down. Revenue is all the money a business brings in from doing what it's supposed to do. Selling its main products or services. It's that big, impressive number right at the very top of a financial statement, which is exactly why it's called the top line. But here is the most important part. This is before a single penny has been spent on anything else. And here is that classic mix-up side by side. Think of it like this. Revenue is the entire pie, every single dollar that customers paid you. But profit? That's just the little slice you have left over after you've paid for the flour, the sugar, the electricity for the oven, your employees' salaries, everything. That's why they call profit the bottom line. It's what the company actually gets to put in its pocket. And this brings us right back to our head scratcher from the beginning. A company can absolutely sell more stuff than it ever has before, bringing in record high revenue. But if its costs, maybe for shipping or for the raw materials or for a huge marketing campaign, are growing even faster than its sales, it can end up with a net loss. So remember this, high revenue is great, but it doesn't automatically mean a company is making any money.
But wait, it gets even more detailed than that. Because for the real pros, for the serious analysts and investors, it's not just about how much revenue there is, but where it's coming from. See, not all money is created equal.
And this is where we get the difference between operating and non-operating revenue. Operating revenue is the good stuff. It's the money from the main show, a car company actually selling cars. Non-operating revenue, that's from the side hustles. It's that same car company renting out a spare warehouse it owns, or maybe earning some interest on cash it has sitting in the bank. And that distinction is so important because it tells you if the company is actually any good at its main business, or if its numbers are just being propped up by some one-off extra cash. And of course, businesses aren't the only ones who need revenue. For governments, it's the absolute lifeblood of everything they do. But the way they've collected that money has changed so dramatically over the centuries. I mean, this is a pretty wild ride. Just imagine, in ancient Mesopotamia, you might have paid your taxes with a sheep or a portion of your crops. Then you get to the Roman Empire, which basically outsourced the job to these private tax collectors, the publicani, who were notorious for shaking people down and taking a huge cut for themselves. Now fast forward to the US in 1915. Back then, the government was mostly funded by excise taxes, so taxes on things like booze and tobacco, and tariffs on imported goods. And you can see that massive shift right here. Look at this. In 1915, almost 80% of US federal revenue came from those taxes on goods and imports. Income tax was this tiny, tiny little slice. Now look at today. The whole thing has completely flipped on its head. The huge majority of government revenue now comes from individual income tax and payroll taxes. Those other sources have almost disappeared in comparison. Okay, so we know what revenue is and we know where it comes from, but now we're getting to what is honestly the trickiest part of all. When do you actually get to count the money? When does a sale officially become revenue? Let me give you a really simple scenario. Let's say you sell a yearly subscription to a magazine. A customer pays you the full price, all up front, in January. You've got the cash, it's in your bank account. So can you count all of that as January revenue? The answer is a hard no. And it gets at a really fundamental rule in accounting, and the answer is all about these two concepts, accrued and deferred revenue. Accrued revenue is money you've earned, but you haven't been paid for yet. Think about sending an invoice for a job you just finished. But deferred revenue is the total opposite. It's money you've been paid, but you haven't actually earned yet. And that annual subscription, that is a perfect example of deferred revenue, because you still owe that customer 11 more magazines. You haven't earned all that money yet. Now, this isn't just some casual guideline that companies can choose to follow. To make sure that everyone's playing by the same rules, so investors can fairly compare a company in the US to one in Germany, accountants have to follow a very strict, globally recognized framework. The whole point is to make sure revenue reflects what's really happening economically, not just when cash happens to change hands. And this 5-step model is basically the official rulebook. It forces a business to break down every single sale. They can't just book the cash when it comes in. They have to identify the contract, figure out exactly what promises they made to the customer and what the price is. And here's the final crucial step. They can only recognize the revenue as they fulfill those promises. So for our magazine subscription, you only get to earn 1/12 of that revenue each month, right as you mail out that month's issue. Okay, phew, we've covered a lot of ground here. Revenue versus profit, how governments get their money, even some pretty complex accounting rules. So let's just pull it all back together. Why does all this nitty-gritty detail actually matter? Well, it's because understanding revenue isn't just some boring thing for accountants. It gives you the truest measure of a company's sales performance. It's the number businesses use to plan their budgets and figure out how much stuff to make. It's what's essential for any kind of accurate financial analysis. And it even reveals the financial health of our own governments. Really, it's the starting point for almost every single important financial conversation there is. And that leaves us with one last, really big question to think about. We spent literally centuries creating these incredibly careful, precise rules for how to measure money. But in our intense focus on revenue, what other crucial forms of value, things like our impact on the environment or social well-being, are we still completely failing to measure at all?